Alrighty, Doc here from North America. Good morning, good afternoon, and good evening. Let's see what we got going on here this morning. You can see, start off with, the dollar is staying in its range, and the Swiss is staying in its range. Um, just when you think that, I guess we'll really know in the end is it'll be a tip-off, without a doubt, is that these currency pairs, and so many of them are in a trading range over the last couple of years, we'll see it move out of their range. And when they move out of their range, then we will know that something is really coming along from the Federal Reserve. But right now, they seem to be on stall, or they're waiting. We've talked about this every day over the last, every morning we talk about it for about 4 or 5 minutes about how the the Federal Reserve is not doing what it's supposed to do, and it becomes the constant confusion of it all. It's like, when are they going to do what they're supposed to do? And I would imagine we'll see it. They'll change the range a little. Well, at first I really didn't think we would change a range. That was the whole premise of my thought, is that they would not change the range. In other words, the Europeans would raise their rates, we would raise our rates, and they could keep the range. I mean, that seemed to be the most logical thing. And you can see here this morning, we're looking at the Swiss franc against the dollar, and it's meeting its right there. You can see, where is it at? Right there. You see it's hit its top. It's got red going down again. You see the white against the dashed line here, and the fast and slow breaking down again. You see it over here on Chicago. Where's it at? There it is. Chicago Quant. You see the same thing. It's hit the dashed lines of the range that we seem to have been following. We don't alter them when they make it, we don't move it up like, oh, let's move it up to there. We don't try to do that, like widen the range. We just leave it there. We leave it in the range that it has been in and let it do its thing. And so, here we see, they've hit the top end of the range, and what are they doing? They're just rolling over again. Same old game, same game, different day. And that's pretty much the action we see there. All right, let's see, what do we do here? Let's jump over to the Dukascopy website, and let's see if we have anybody asking any questions this morning. And we'll go through all the pairs, trades, and so forth that we watch normally.
Still wasting time.
And obviously, if anybody wants to see something, we gladly just put it up on the chat line, because we like to see, and well, as we always say, in a proactive trading world, where that's what we are nowadays, we're proactive, not reactive. We need to hear the most, as many ideas as possible, good or bad, doesn't matter. Just let's hear them. Let's look at the different products, because you can only respond to X amount of different products, as an individual trader. If you're in an office, you have 4 or 5 people around you talking about different things. But if you're trading from your own private office, you may only be hearing 1 or 2 opinions. And in this case here on the webinar, we always hope to. Oh, there's Jordan. How you doing, Jordan? Haven't seen you in a while. Was looking for the Fed's nominal interest rate. Is it at 2.5%? Right now, the 30-year is trading around 2.10. And the 10-year is trading around 1 point, I think it's like 1.7. I'm looking right now to see where it's flashing. About 1.78, something like that. It's kind of hanging around there. It hasn't really been able to. Okay, there it is. Yeah, its yield is 1.779, so 1.78 on the 10-year. And so we're not really seeing that much movement, which is very confusing, because fundamentally you would assume that with 7, 8, or 9% inflation, they would start to perk it up. And I think we made our headline yesterday of our webinar, kind of insinuating that Mr. Powell may be right. It may be transitory, but it's not transitory over like a 3-month period or 6-month period like he suggested. But it may be a 2-year transitory situation. So, we're going to see in the next 8 or 9 months, it reached its peak. And I remember, in 1980, when we were going through all that horrendous inflation, and it was going on during the Jimmy Carter years, and Mr. Reagan got elected, and the moment he took office in 1981, in January of 1981, at the beginning of the year, he took office. Uh, interest rates were at 21%, and they had climbed to 21%, and inflation was yielding about 14.5, 15%. So it was like a 5 or 6% cushion, and that was the top right there. He took office, and that was the top. And his policies dealt with inflation and dealt with regulation, and they, before you knew it, they were coming down, and the cushion was started to shrink too. Instead of 5-6% cushion that was only during the Carter years, the cushion shrank down. In other words, if inflation was 16%, then interest rates were only 18%, not 5 percentage points or 6 percentage points higher. And then it got to a point where by the time Mr. Reagan left office, inflation had been cut by 50%. So I hope that helps you. Was trying to work out the real interest rate calculation, nominal interest rate, inflation equals real interest rate. Is that correct? Yes. So let's just look at that again, and that is that let's see, interest rate. It said the real interest rate calculation, the nominal interest rate is inflation equals real interest rates. Let's see, was it interest rate minus inflation? That's it, right. So in other words, inflation right now, let's say it's 8%, and interest rates are 1.78 right now on the 10-year. So let's just round it out to 2%, okay? Because this is just a simple calculation. So you take the 2% 10-year, and you take the 8% inflation rate. That means that right now it's a -6. Does that make sense to you? So the real nominal, you're getting a -6. In Europe right now has been getting like a minus quarter or half or even worse, because not only we've seen where inflation in Europe at one point or another was really a little bit higher, and without growth in GDP and so forth, you had basically bonds yielding minus a quarter point or 3/8 or something like that. And so in other words, you bought the bond with your money, and at the same time, instead of you getting interest from the government or whoever you bought your bond from, you had to pay who you bought the bond interest. So not only did you pay for the bond, you had to pay them interest to own the bond, which is kind of backwards there, Take a sip of our tea here. So yeah, real interest rates right now are like -6% here in the states, which is pretty wild, And usually stocks are bought because of that, because they buy stocks in companies that can raise their rate, what they sell things for, and that's the procedure that goes on there. And so we were talking about it yesterday. We were a little disappointed that like a Bitcoin doesn't seem to be able to get out of its own way. It's trying to firm up with the stock market as the stock market rallies, but we really thought that Bitcoin, in a circumstance like this, we really thought that we would see Bitcoin trading at, say, with inflation like this, like $95,000 or $100,000, when it was up at $70,000, and when the inflation was confirmed by Mr. Powell. Instead, it rolled over with the rest of the stock market, which was really odd, because we thought that these cryptos would basically follow their own path of security. In other words, their own path of being independent of the Federal Reserve, to be independent of stock markets, be independent of interest rate markets. In other words, be independent of all those characteristics. But it didn't really happen. Oh, which would encourage borrowing to promote growth in the economy. Let's see. Let's try to figure this one out. What you're saying there. Let's see. Which would encourage borrowing? Is that you mean the minus? No, it's to basically what happened was there was a lack of confidence, and so we have to go back to what this is all about, and what it came down to is the collapse of the financial system in 2008. The financial system basically collapsed in the world. What happened was there was too much lending to too much unsecured debt. So in other words, people were getting money and allegedly having property to back it up or income to back it up, and they created something called collateralized debt obligations, CDOs. And what they did is they packaged good debt with bad debt. And so what they theorized was that the socialists did this in our Congress, and Barney Frank was the Democrat congressman who led this strategy. It started off with Bill Clinton with redlining, and he used his attorney general to challenge banks. Why they used to call it redlining is because banks would classify real estate and loans at higher rates in communities that were poor. And so the socialists said, no, that doesn't mean anything. Lend them money just like as if they have money. And we kept on saying, no, that doesn't really work that way, because when you're lending money, you have to have assets to back it up. And so they started the procedure, and they called it redlining, and they lost in the courts and so forth, but they still, through legislation, threatened banks, and they pressured them. And so what they did is they kept on manipulating the auditors of the banks, which were part of the Federal Reserve and the Treasury Department and so forth, to basically abuse and hurt banks that lent money in the red line areas, and force them to keep on lending at lower rates and less protection. And they forced the banks to do this, and they did it. And then I guess it was Mr. What's his name? Mr. Clinton was gone, and Mr. Bush was in, the son of the former president, and he kept on warning them. And there were all these YouTubes, and he would tell the Democrats, you can't do this. This is going to hurt the financial markets. And in 2005, 2006, he was really pushing hard after he got reelected in 2004 about they must clean up this stuff, but they just refused to. And they kept on threatening all the time and hindering. And when Mr. Obama was running for president in 2008, he really jumped ahead of John McCain, and they were really concerned because he was a socialist, and he was going to just totally wipe out the red line situation altogether. In other words, force banks to lend money, and at the same time hinder banks from lending money to corporations they didn't like politically. And the financial system collapsed. And I saw Barney Frank, who was head of the banking committee, crying on CNBC how he thought he was doing the right thing, and didn't mean to collapse the financial system, and they had to do quantitative easing, and that's how Mr. Obama came in to the presidency with that wave of QE. In the beginning, people didn't understand what QE was because the Fed wasn't exactly explaining it. I kept on seeing it in the trading market, where it seemed like money was buying very oddly. We used to, on the trading floor, we used to call it stupid money. And we were very confused why money would do foolish things. And what it was is that the socialists at that point pushed the Federal Reserve to do foolish things without telling the public what they were doing. And so, now you fast forward to where we're at now. They borrowed trillions of dollars, and they're again they're floating bonds to pay these things, and then they're paying people not to work, and it's kind of like a problem that generates inflation. I know that Mr. Biden doesn't believe that, but it does, and we're seeing it. And so that's why we go all the way into a circle here. I think, when we look at these pairs trades, they're going to stay in their range because I don't think the Federal Reserve is going to raise rates without other countries raising rates. It's all going to be combined together. And with it, I believe the inflation is going to back off because the inflation is more of bad policy than it is anything else. And so within the next 9-10 months, we're going to have like a Ronald Reagan moment. We're going to have this massive wave that we've been having. They call it the red wave, red, white, and blue wave. That's what it is, really. It's a red, white, and blue wave. They just cut it short and call it red wave. But it really means red, white, and blue. In other words, pro-constitutionalist, more responsible government. And you're going to see, what you'll see is this policies change for the better for the world. In other words, the policies will be better overall. Does that make any sense? What is the entry? What do you mean, Thomas? What is the entry? Was doing some research on QE is sort of like pumping extra money into the economy to get cash moving. Yeah, what it was is a combination of things. QE is quantitative easing so that companies can survive. That's what it really came down to. Mr. Bernanke was the Fed chairman at the time. His PhD thesis was what could, in economics, was what could they have done to improve the Great Depression. It was 1932. I'm sorry, no, it was 1929, 1930. And Mr. Bernanke, who was Fed chairman in 2008, originally when he got his PhD, he had written it was part of his thesis about what could they have done better in 1929, 1930 to make the Great Depression less painful. And one of them was quantitative easing. It discussed the concept that instead of allowing the banks to go bankrupt and the companies to go bankrupt, they propped them up. And if they propped them up, that meant jobs would be kept and people wouldn't lose assets. And so it was kind of like a stasis. I guess that's the way you call it, like in sci-fi movies where they put you to sleep so you can travel great distances and not age, type of thing. And so his quantitative easing was designed to basically slow defaults and slow losses. And in this way, they could merge two companies together, maybe one bad one, like they did Merrill Lynch to Bank of America. Or they merged Bear Stearns to JP Morgan Chase. Or they merged Wachovia to Wells Fargo. And it goes on and on and on. They merged companies together. Companies that looked like they were going to go bankrupt, they merged them with solid companies, and that was part of the quantitative easing. And then the Federal Reserve came in and they bought the private bonds of the companies, and so it made the mergers a lot cheaper and easier for the strong company. And at the same time, if you had, let's say you have 30,000 employees at Merrill Lynch. Now they're not out of office. I mean, they're not out of a job. They have a job still, and so nothing's been disturbed. Let's say, you have, I don't know how, Merrill Lynch was our largest private brokerage house in the United States, and Bear Stearns was one of the top ones. That was, and so forth, and it went on like that. They merged these companies together and banks, and they took the Lloyd's of London got merged together with the Exchequer because they didn't have any company that could take care of it. Same situation with Deutsche Bank. They couldn't find anybody to merge it with because it was just too much risk, and so it had to be propped up and owned by the German Federal Bank and so forth. And Bank of Scotland, same situation. Santander, it goes on and on. I keep on. I always name these every so often. Uh, you know, uh, it just they propped them up that way. So that was the idea. Let's see. Am I answering all the questions here? So is it money into the economy to get cash moving? Yeah. So that's what kept cash moving, not get cash moving. It kept cash moving. Hey, Robin. So that was the structure of it all. And so now, what we're coming up to now is we're not seeing gold and silver really make much of a move. I mean, silver went into a buy. Let's break away for a second from one of the currency pairs here, the Swiss. Let's just take a look at gold and silver real quick. Because normally during inflationary times, you see, gold go up. You see silver go up. And as you can see here, gold is not going up. I mean, it's up today. No doubt it's up today. It's green. And it was even a little bit higher than this at one point. But you can see our work is, still reflecting weakness. Now, what's kind of curious is we're seeing strength in the silver again. And we've talked about this of late. We're not really convinced that we're going to see a silver in the high teens anymore. I don't think we're going to see that. I think it's kind of like the channel that's developed in currency pairs. I think in some ways it's developed also in silver. I think silver is way more discounted. You got to imagine silver's trading at what you can see it right there. It's up for the day. It closed in a daily buy yesterday, and it's in a weekly sell as you can see down here. But at the same time, silver is at 22.84 as you see right there. Let's put it up on J4X too. Right there. You see 82 bids at 85. You can see last trade in the United States is 84. In between that market, so that's pretty cool. And so, but when you think about it, its all-time high is like $51, $52. And so it's over 50% below that number. Whereas gold, the all-time high is I think like 2150, something like that, and it's trading at 1800. So it's only like 18% below its all-time high. Whereas silver's actually is like 61% away from its all-time high. So I think that silver is undervalued. I think money looks at it that way, but I don't think that they're running towards the silver market or the metals market for inflation, because I do think, in the end, I think Mr. Bernanke will be not Bernanke, Mr. Powell will be right, and that is inflation will be transitory because we really don't. We only see most of the problems with inflation right now is through bad policies, not they call it, they say supply chain, and they talk about the COVID and all that stuff that has had an influence, but overall they're more because of bad policies than they are. Notice that when Mr. Trump was president, inflation wasn't picking up. As soon as Mr. Biden got in office, literally in a matter of weeks, inflation started to kick up because he did executive orders. Within the first couple of days, he did more executive orders than any president in his first few days than any president has ever done. And he really tangled the financial system altogether and supply chain and everything else. He really did negative things that hurt it, not help it. Does that make any sense what I'm saying here, traders? We've really drifted away from the pairs trades, but it's all related. And that is that currencies are governed to a great extent by inflation and interest rates, and that's why they follow CPI, Consumer Price Index, and they follow the PPI, Producer Price Index, for producers, and they follow the GDP, the Gross Domestic Product of a country, and they follow the employment situation, how much employment or unemployment they have going on. So in other words, they look at those fundamentals to decide what interest rates should be, and the return you'll get out of something because of the structure of it all. Okay, good, Jordan. Thank you. I appreciate someone saying something. So because Doc can really slide out there into Never Never Land because of my mental prowess of memory and living through all this. Between Robin and myself, what do we have? Almost 100 years of trader experience. We're in the 90s at this point. I have 40 some odd years. Robin has almost 50 years. So we've lived through all this. Robin used to trade eggs. Did you trade butter too, Robin? And then I was mentioning that Robin was standing in the S&P 500 pit the day that they started trading the S&P 500 pit, and he was, if he wasn't the first bid and offer, he was the one who figured out what premium they should put on the product in this trading pit. Everybody looked around and said, "Okay, what price do we trade this thing at?" No one's ever traded it before. And Robin said, "Well, let's put a premium on it." So they put a premium on it. So we've got a lot of experience here, and it can pour out accidentally at the same time. When you ask a question, we're going to give you what we see, what can be backed up by previous history and fact, pretty consistently and easily. So anyhow, where did we leave off? We were looking at Swiss, right? So let's go to the euro from here. Euro's doing the same exact thing. It's lifting up. We're seeing the euro, going back up, bouncing off that 0.38. I think it was. Was it 0.38? Yeah, no, 0.23. So it's bounced off the 0.23. You can see that right here. There it is, right there. Let's see. It looks like on J4X. But anybody has a question or anything, don't be afraid to ask it. I've always said that there are no wrong questions. There are no dumb questions. There are no real smart questions. There are only questions, really. And pretty much the only difference is that there are short answers or long answers. That's all it comes down to. And you just heard a long answer trying to explain the inflation concept, because it is kind of unique. I call it state-sponsored terrorism myself. But anyway, that's the way it rolls. So there you are. You see the euro. It's turning up here on J4X. You can see the green here on the Hinky ASCII bars. You see same thing here. We got lots of little green dots kicking up on our Chicago quant. Right there. See that there, and then you can see same time we are through the zero line, and I think we're on the second day of the buy. That's what it is. Where'd the little line go? There it is. Okay, there we are. But I notice our weekly is still banging along the time manifold and on the negative side of it. So we're a little curious about that, but we'll see. And see if they start to lift that thing up. Again, I keep on expecting to see rates moved up across the planet. So I'm thinking the pairs trades will stay in their trading ranges. We'll see. Now here you can see same situation with GBP, the cable trade, British pound against the dollar. Second day in a daily buy. Right there. And you can see it's been in the sell for like 11 days right there. And you can see we were flirting with the weekly sell, and now we are moving away from it. Starting to perk up again. So, it sounds like the currencies are going to try to stay in their range, and you can see how they've bounced around in it. We Fibonacci this range here. You can see there's the top of the range right there up in the 140. Let's see, what is that? That's the 143, 42 and a half area. And the bottom end of the range is the 131 area. And you can see we've come down and met it a few times and bounced along it. And, it's following the Fibonacci sequence, the range is very well there. All right, from here, we'll zip over to the Turkish lira, which is incredibly now the leader as far as I'm concerned. From being the worst pairs trade in the world, now it seems to be almost one of the better pairs trades in the world. And there it is right there. You can see it's trapped in that big little box we put up there now. We think it's going to stay in that range for a while. We think we're going to see it bounce around in that range and probably find a way down somewhere along the line. Now, you can see it's flirting with the euro against the Turkish lira today, fighting to get into a buy. But you can see the weekly is burying itself. There's a lot of pressure on it there. Let's check out the dollar Turkish lira, same situation. Right there. And it's still not getting into the buy as fast and simply as the euro Turkish lira is. But both weeklies are getting buried. They are getting pushed down pretty hard now. All right, over in from there we go over to the Canadian. See what's doing with Canadian. I understand that the truckers' protest is really catching a lot of success. I understand that where is it? Quebec has a vaccine tax and has had to drop it because the population is getting fed up with this command and control type stuff that goes on with the socialists. So at the same time, Mr. Trudeau seems to have run away, hiding, claiming that he has COVID, but I don't understand why he would have to leave his home if he had COVID. But he ran when these guys showed up. Another question, does the 10-year yield represent the interest rate? Not really, no. That's part of the quantitative. The concept of quantitative easing is that they lend, or they keep everything liquid. How'd you say it before it made sense? Something about cash? Let me see, where'd you say it? It made a lot of sense what you said. Where is that at? I saw it on the chat line. It said, which would be encouraging to borrow, promote growth in the economy. Okay, it says, oh, there it is, where you say, Jordan says, was doing some research on QE. Is it sort of like pumping extra money into the economy to get cash moving? That's a good way of describing it. You wrote it very well. And what it is to keep cash moving along and keeping companies alive. And so that means if you keep the companies alive, that means you keep the jobs alive. Keep the jobs alive, then people have income, or they don't lose their homes, or have issues financially. So it's keep the cash flowing. And what Mr. Biden has done is he's exploded it. He used COVID as an excuse to float. Mr. Trump floated like $1.5 trillion, and the Democrats have basically now floated like another $4 trillion. And so, and $1 trillion of it is not even being spent yet. They have so much cash flooding the marketplace right now, it's generating inflation. More money chasing less product. And so that's what's really going on there. So when you say, is another question, does the 10-year yield represent the interest rate? It's not that it represents the interest rate. It is an interest rate, of course. But the idea is it's trying to keep interest rates at a very easy, measurable amount so they can pay back debt. Remember, government has to pay interest in the United States. It does. It pays interest on 10-year money, whereas 10-year, what's the interest rate on the 10-year bond in Europe, or the European Central Bank's bond, is minus. It's like an eighth or 12th or something like that, or a quarter. So it's not. It comes across my tape here every few minutes. See if I spot it again. But they're doing it because they're in so much bad shape. Europe was really hurt by the collapse more than the United States was. The United States is the world reserve currency, so it got away with printing money and propping up businesses, whereas the European Union had to do more. They had to prop up more companies. They had to prop up more businesses because it's a socialist structure, whereas the capitalist system is freer, and so it has more growth in it. whereas socialism has, or communism has no growth, or it has minus growth. And I know you'll say, what about China? It has 6% GDP. And that's not real. So, I mean, you can, here's German DAX. And it's not real because it's not a floating currency. And so it's a fixed currency. And you can't, it's not transportable and so forth. So in other words, the Turkish lira is a floating currency. The dollar is a floating currency. The euro is a floating currency, even with central bank influence. But the Chinese yuan is a fixed currency. They set the price. I always like to use the old Soviet Union as a good example. The ruble was 4 or 5 to the dollar, and then when the Soviet Union collapsed, it was just a matter of a year or two, or a couple of years. All of a sudden, the ruble was now trading at 12 or 13. It tripled in value, and it was because it's a floating currency. And then you saw throughout the years as growth didn't accompany, or there were problems, or there were restrictions, or whatever was going on. Now you see the ruble. Where's the ruble at? Let's put the ruble up there. The ruble is trading at was that 75.70. We're in a daily sell for 4 days now, going on 5 days, and we're flirting with our weekly sell that we've been looking at. And so I don't know why my red line disappears on me like that, but right there's it. So there was the sell right there. We've been in a sell since here, and it's been moving down. So the ruble's now, which used to be 4 to the dollar, is now 75 to the dollar. That's a floating currency. Whereas the yuan has been trading in the 7 point something, the 7 point something, the almost 8, back to 7 point something again for decades. In other words, if the yuan goes to 14, all of a sudden that 6% or 5% GDP becomes 3% GDP. If the ruble has gone from 4 to 75, let's say worst case scenario for the yuan is it becomes a floating currency, and matter of fact, I saw today. Do you know that China is considered a developing nation? It's not even it's not. It's they get foreign aid still. So that's really weird. I mean, if they were really 6% GDP, and they were really legitimate numbers, they wouldn't see those. They wouldn't be a developing nation. They'd be an industrialized nation. And so China is still listed as a developing nation, and they actually get foreign aid from the United States besides all the trade that we give them. And they get foreign aid from like the World Bank and so forth still. And so imagine if the yuan went from 7 to 21, then their GDP is basically minus. So that's the problem with it all. So the 10-year yield is as a fixed rate. The U.S. government, because it's the world reserve currency, can afford to pay. Also, it's a capitalist society, so it can afford to pay interest on its bonds. Whereas the socialist countries and so forth have a real problem. They really don't have the growth. They just don't have that growth. And so China, which was smart for China, and that is, don't let your currency be a floating currency, or they wouldn't even have a GDP. They'd be minus. Does that make sense? If you have any questions at all, please ask. You will not be disappointed. Murray and I have 90 years of experience between it. Exactly. Awesome. Thanks, Robin. I really enjoyed talking, trading, and learning new things about the marketplace. Cool. Sounds very friendly to me. So yeah, that's the issue at the time, is to understand the mechanics that we're seeing, because a lot of this, the trading ranges of the currencies and so forth, this is really what's really propping up the marketplace and its action. That's what we're seeing here, is money basically parking itself and not working. That's not good for growth. So that we see what we see with that. Let's go back to the currencies here. You can see it in the pair. Oh, right there. Let's go to the pairs trades. So where did we leave off? Canadian, right? Yeah. So right there, you can see Canadian's trapped in its range, which has been the same way for a long while too. You can go back, over a year. It's got that same thing going on. With its range, and parked itself on the range, and it bounces back up. And that's because we learned a simple thing when Mr. Trump was president, and that was his Secretary of Treasurer, Mr. Mnuchin, who's a hedge fund guy, a trader himself, used to define who was manipulating and who wasn't manipulating. But they don't really publish the policy itself, so we're not really sure what the rules are. But what we did hear all the time is every quarter he would come out and make a statement about who is manipulating and who is not manipulating their currency. So that told us that they have some established rule about the range that they want to keep these currency pairs in. So that's why we were able to identify the ranges and be able to follow the ranges pretty easily, because they were giving us a heads up that they actually established that policy. They haven't published the policy. All they would do is publish who was manipulating and who was not. And once in a while, someone would be told that they're manipulating and who is not. Now, we don't see the rules that they've written, but we do see the after effect. We see how a product will trade in a range. So obviously, as long as it stays in its range, they didn't seem to call it manipulation. And when it stepped out of its range, they called it manipulation. So we just set the lines to where they defined manipulation or non-manipulation. And you can see it fits perfect. You can literally Fibonacci it, and you can see it trades it pretty well. All right, from there, let's see, where did we leave off? Let's go over to, let's put Canadian on the J4X here. Right there. You can see the pressures on it again, just like it is on our Chicago charts. Right there with the red dots. And went into the sell there yesterday. And you can see the weekly is trying to lift up. It came in as a weekly sell, but it's been very firm all week long here. It's Wednesday. And so now, let's see. From there, we drift over to, usually we look, when we look at the Canadian, it's usually pretty well kind of used as a guidepost to like oil and metals, just the same way the South African Rand is. So let's take a quick look at oil. So we're going to leave the Canadian dollar up on J4X, but we're going to show you what oil looks like through Chicago Quant. This way we can see both of them and see the characteristics. And there is oil. You can see it's firm. It's through the daily buy. It's been in a weekly buy for 2, 4, 5. This is the 6th week. So we see the strength is there. And you would assume because of that strength, as you see here on J4X, you see that overall, Canadian had been moving down with the strength of oil moving up. And then we had this strange hiccup here. That was probably part of the truckers thing and the passport vaccine thing and so forth. It probably shook up the Canadian financial system a little bit there. And now it seems to be slowly straightening out because of the truckers basically putting their foot down and saying this is absurd. And now we're seeing populations in the east in Canada start to say this is absurd. They were actually talking about putting a tax on people if they didn't get their certain vaccines. Wow, that's a weird one. So that's where we are there with the Canadian, as you can see on J4X, and you can see here on Chicago Quant the oil action. And usually we see the same thing with the metals. So let's just put gold up there, or silver, or something like that. Let's see, where's that? Right there. Now you can see gold has been more weak, than it should be for this inflationary period. But then maybe, as we said in our title yesterday or the day before, maybe gold and silver are recognizing the fact that the inflation is going to be transitory. It's just not in a 3 or 6 month period. It's probably going to be a 2-year period, and that's probably, once we get through the next 9, 10 months, we could see a Ronald Reagan moment, as I said a little earlier. Next thing you know is that inflation starts to back off going into January of 2023. And so, as the old saying about buying on rumor, selling on news, in this case here, the rumor probably is that inflation is going to come down, not go up more. We'll see pressure on it, over the next 6 to 8 months, of course. But I would assume it's going to be very hard for inflation to hold up because the policies are going to change dramatically over the next year and a half. And so because of that, we're going to see less problems. ADP jobs data imminent. Oh, we're going to be getting the ADP numbers. Let's see what that looks like. ADP data minute. Let's see what it says. Minus 301,000. 301. Let's see. Total private payrolls estimated to be 2+. So the private payrolls is a big swing. It's a 500,000 difference in the wrong direction. I see ADP payrolls revised to 700 and some odd thousand in December, down 31,000. Okay. Goods and service areas and non-farm. Non-farm is up. This is from the Bureau of Labor Statistics. Okay. All right. So the pressure again is we're finding we have like 11 million jobs. People are looking for jobs, and a lot of people are being paid not to work still. So once that stops, that'll start to help the inflation factor. That's why Mr. Biden hasn't been able to get anything passed anymore. The senators and Congress people, to a great extent, realize the damage that they're doing by supporting his policies. Wow, 301,000. Yeah, I think it's all temporary what we're seeing here. And we've seen the 10-year yield go from 1.779 down to 1.773. So interest rates are actually dropping on that news. Stocks looks like they're backing off a little bit from it. Nothing major. Actually, they're flat. I mean, flat from the news. So they're, the Dow Jones Industrial Average is only up a half a point. I'm sorry, 57 points, which is 58 points, something like that. And the real fair value, like an inflation thing, is only 9 points up. Same thing with the NASDAQ 100. The real value, it's up 238 points, but the real fair value is only 10 points in it. So, the implied value is, let's see, how's that? Oh, okay, so yeah, no, that's pretty high up still, 231 points for the NASDAQ. But that's where we are with these numbers, is that I do think that we're seeing numbers that are going to kind of disappear. And the bad numbers are going to go away. And I think that's what probably gold and silver is trying to tell us. They're probably trying to tell us, no, we're not going to be panicked, and we're not going to run to these metals because we don't think it's going to last. I mean, that seems to be the whole thing there. Let's jump over to the South African Rand. Let's see how that's going. All right, right there. This is a big weakness signal. That's what this really is more than anything else. And the real conversation now is, will they raise rates? I know they're going to raise some rates. They have to do something. They have to make it look like they're fighting inflation. So they're going to do it as a token thing. But I think that's why you see the metals complex is really not going anywhere. You know, they just know that this is going to end very soon. Mr. Biden's not going to have any power after next January. There's a good chance he'll have no power, but just some executive order power, and that's it. He will not. He will. They will. The House of Representatives will be governing the country with an iron fist to clean up this mess, because he's not going to. They're going to have the Republicans are going to have more seats than they've had since the Civil War of 1861. It's that big a wave that's hitting the country right now. It's happening everywhere. And you know, every time there's an election, places where Republicans don't win, they win now. They win. You know, they haven't won in 50 years, they're winning. You know, they haven't won in 100 years, they're winning. So a lot of the country is kind of had it with the pressure that's been put on the economy itself and the lack of growth. We're really a capitalist society, so we're designed for growth. It has to have growth. You know, what did they used to call it? Creative destruction. So, you know, this is not going to last. We're not going to let it last. Americans overall don't let things like this happen. You know, they find ways to grow, make money. That's the whole process here. So, you know, the Fed will raise rates just to show that they will fight inflation, but they're not going to walk away from this. They'll have to raise a couple of rates, but there's a big debate about what they're going to do. I mean, you know, will they raise 4 times? Will they raise 5 times? Will they raise 6 times? You know, different major brokerage houses have defined how much they think is going to raise, and you know, I think it's going to be the least amount, not the most amount. At one point, we were thinking that they were going to raise at 0.5%, you know, to show the American economy. No, we care. You know, we're going to challenge the problems, but that didn't seem to happen, which is really odd. So, all right, where we go from here? How much time do we have? Oh, 22. Okay, that's not too bad. We're doing all right. No, no. They're not going to raise it that high. They're going to just to show that they're fighting inflation, because real rate increase would be about up to 8 or 9% if they were really fighting it, and they're not. And the markets and the stocks and everything else do not reflect that either. Let's see, from the South African Rand, as you can see right there, it's perking up a little bit. So that means it's pressuring the metals complex in the reverse. Let's just throw metals up over there. There's the gold. And so it's pretty much unchanged. The South African Rand, as you can see on Chicago Quant, has been moving down. And you can see gold has been trying to go up for the last couple of days, but not doing too good a job about it. And you can see it right there. There's Fed gold in our work. It's in a daily sell for 5 days now. It's trying to do something, and the weekly keeps on pressing down, not pressing up. So the rates, raise the rates to slow the economy is not, they're not, no, it's the other way around. They're probably not going to raise rates because the economy is showing that it is slowing down, you know, the employment thing. But again, I really do have a feeling that the metals are telling us something and we're just not able to understand it. It's speaking a language we don't understand. And I really think that what's going to happen is it's trying to tell us that inflation is going to go away. I do. I think it's going to go away, and they know it's going to go away. They know, you know, they may not say it out loud, but they know that the policies and everything Mr. Biden has been doing has been a negative. They can't really say that stuff out loud. You know, people get angry. They can't understand. They don't like to combine political government activity with economics, which is really strange, because it's totally, I mean, who has the power to tax you and take your money and do different things, and do good policies versus bad policies versus good policies, you know, that type of thing. All right, from there we'll go over to, we saw what the ruble looked like right there. You can see the ruble's moving down, which is a very nice thing. And you can see it's even flirting with its weekly. I don't think there's going to be an invasion to Ukraine. I think that where they are is where they're going to stay. And I think as time goes on, one of the fears, the real serious fear that I keep on hearing is the Russian Federation is not exactly happy having Russian-speaking people find out what freedom looks like. Okay, so if inflation gets too high, the Fed can raise interest rates. Exactly. But I don't think that, and they're not going to raise them like the calculation you did there where you showed interest rates versus inflation. They're not going to raise them to, they're a minus now by 6+%. So in other words, they would have to really raise interest rates 6% more if they thought inflation was here to stay. Yeah, do you see what I mean there? Now, yeah, they try to slow the economy, but they try to do it in a way that few dollars are chasing more goods. Is that the way to say it? No, the other way around. Too many dollars is chasing too few of goods, amount of goods. In other words, if you have if you have, 1 million boxes of cereal being sold every day, and the supply gets smaller, and they drop underneath 1 million, then the price of the cereal goes up. Capitalism. And so that's the idea of rate increases and decreases, is to sop up the extra capital so it can't go and push the price of cereal and so forth up. So we're in essence, what it really comes down to is we're really in a range of everything. The whole world market is in a range, and the economy's in a range, and the currency pairs are in ranges. They're trying to keep everything stable. That's the answer to the whole process to begin with. Stability. That's what they're really fighting to do all the time, is they want to keep currency pairs stable. They want to keep interest rates stable. They want to see companies not go out of business. Instead, they want to see them survive and grow stronger and become more profitable. So in the end, they don't go out of business. Everything, they want stability. Stability is the whole process of quantitative easing. That is to prop things up. And so that is really the answer to it all, is stability. Yeah, stability. Which is kind of odd, when you think about it. But, it makes sense, if you can grow out of these problems and not devastate the economy, but just get rid of the bad players. See, that's the problem, is the stability keeps some of the bad players in business, which is kind of like, no, don't do that. We don't want you to keep the bad players in business. That's really what it comes down to. So the people who made bad choices need to be gotten rid of, and the companies survive. That's what it really comes down to in the end. All right, traders, we're out of here. This is Doc from North America. We will catch you all tomorrow on Thursday. Today's Happy Hump Day, right? And I think the little rodent saw his shadow. I didn't even see. Anybody see what the groundhog saw? I missed it. All right. Happy trails to you until we meet again, which will be tomorrow, Thursday. Happy trails to you. To all our trading friends, take care, traders. Ta-ta for now.